All right, what is going on, everybody? So I just got fired up from a Twitter post that I saw, and I shouldn't let things get to me, but I did. And so I'm fired up because it is making me do the video that I've been wanting to do for the last little bit. Anyway, so here we go. I got a handful of things that I want to talk about today. I want to talk about obviously where we are in the markets, both, crypto, Bitcoin, et cetera, but obviously the broader economy and the broader markets and equities and all of that. I want to talk about what this actually looks like, because there is so much noise on crypto Twitter or wherever you look, and all of these people everyone is just posting, in my opinion, for engagement, right? Like that's what this has all come down to. And so you have to really do your due diligence to sift through the crap to actually get to what is real and what is true and what is honest versus just entirely and completely disingenuous, which is what I came across today. And so I'll show you the post and kind of my response and how it feeds into my entire philosophy on what is happening and kind of what we can expect, not just over the next 3 to 6 months, but maybe even the next 3 to 6 years. So let's run through this first. Let me go to Twitter, and let me go to what is going on here? Notifications. All right. So this is the post that got me all fired up. I hope you guys can see this, but anyways, what got me all fired up is Finance a Lot posted this thing, and I see this all the time. I think we have a massive recency bias in the world, and I think it's also recency bias is also playing into people's assumption about where Bitcoin is going to go, because they're like, well, it did this in 2018 and 2019, and we're just going to repeat the same thing. And that's not how markets work. Like, there are similarities, things rhyme, but that doesn't mean that it's going to reproduce the exact same scenario. And it especially doesn't mean that it's going to reproduce the exact same scenario because that was the most recent thing that happened. So in my short Cliff Notes opinion, the recency bias that exists in all of these calls for this massive global depression, it's going to be a repeat of the 1929 crash, 1930s, so on and so forth, is because of 2008 and Michael Burry and moves like The Big Short and Margin Call and everything else. Everybody wants to be the next Michael Burry. Everybody wants to be the next Big Short, where they call they make this super crazy doomsday-ish call, and they are forever enshrined in the Hall of Fame of finance because of it. And so I think that's part of it. I think people are looking for it, number one. And number two, I think we've gone through a little bit of a period of time where all we know is huge moves, right? So like, we've basically been in it's either been only up, or it's been in either up only moment, or it's been massive bubble pops starting with the 2000s. So we had the huge tech bubble burst. I'm going to flip on over to the NASDAQ real quick. We had this huge tech bubble burst in the 2000s, and then we got over to the 08 crisis and the GFC in 2008, and then we had COVID in 2020. And so they assume, well, we had a huge, massive crash of 50 to 60% in 2000, 70 something percent for the NASDAQ or whatever it was, 80%. And then, a massive crash in 08, and then huge crash in COVID. And so, well, another crash must be coming rather than just a recession. I don't believe that we are going to get out of this thing scot-free. I don't believe we are just going to go on to an infinite bull run without any repercussions from printing endless amounts of money and all these other things. But I think people forget that we can have moderate recessions. For a century, we have had more moderate recessions than absolute collapses, and yet it seems that we are only willing to assume one of two things: either a massive melt up, blow off top, or a massive implosion where it's going to be repeated in the 1930s. That's just not how the markets work. And so with this recency bias, I think that is what is you take recency bias, and then you take people that are just looking for engagement, and that's why you get these calls for either one of those two things. Saying it's just kind of meander doesn't draw likes, it doesn't draw clicks or shares or anything like that. If you proclaim that the world is going to end, or if you proclaim that we're going to go to the moon, those are the only two things that get actual engagement. And so that is creating a lot of stuff like this. So Finance Lot posts, the era of free money, cheap debt, and growth at any cost is over. The general public doesn't realize it yet, but they will very soon. And then he does, and I don't necessarily disagree with that first part of the post. What I hugely disagree with is this next comment, which is he makes a correlation to the first market peak on September 2nd, 1929, to our peak on January 2nd, 2022. That's the starting point. Okay, fine. And he just makes this weird correlation of plus 4 months, just saying like, well, September, January is 4 months after September. So September 1929 plus 4 months, January 2022, right? Those are your peaks. And then he says the second market peak, which is he's looking at this retracement, right here, this retracement. And what he says that he makes an equivalency that the April 15th, 1930 retracement second peak is equivalent to, because it's also plus 4 months, August of 2023, our second peak. And so he's saying we are replicating in so many words. Hey, looking at this, 4 months difference from the first peak, and then a 4 month difference from the second peak. And so, well, look, if they're the same, and it's going to be another bubble pop, and here comes Great Depression. And so I had to write this response because it is so frustrating and irritating. And I said, bro, your dates don't line up at all. Just taking September plus 4 months equals January and April plus 4 months equals August is either intentionally disingenuous or completely devoid from understanding actual timeframes. And this is my huge point, the entire point that I want to make for this video that I've been delaying. And so I thought it perfect, because now he gave me a reason to get all fired up and actually make the video. Because the second peak in 1930 was only 7 months, April of 1930 compared to September of 1929. It's only 7 months. That second peak was 7 months after the peak. We are now 20 months, January 2022, and now we are in September 2023 from the peak. We are 20 months from the peak. That is not the same as 7 months from the peak, and that is not how bubbles work. Could we drop from here? Absolutely. But this is not a bubble pop. This is a picture-perfect replay of the late 60s into the 70s, which I'm going to go into, in terms of time frames. And here is the premise for my entire video today. Every time we broke retracement levels, the 618, the 702, the 786, every single time we have broken all retracement levels like we have now. And by the way, we have, if you look at the NASDAQ, Dow, and the S&P, we have broken the 786 fib on all of them. That is typically known as the last fib retracement that can or typically acts as a retracement before further downside. Every time we have broken all retracement levels like we have now, when they are in excess of, when that retracement comes in excess of 12 to 14 months after an all-time high, we break into new all-time highs. It happens every time. You want to talk about this time is different? Like, if you want to play by the book and not play by that game, because I agree that is a dumb game to play, that this time is somehow different, then you can't play that game here. Because you can't say, well, this is going, I'm going to say like, hey, this is replicating a previous incident like 1930, but yet it doesn't resemble it at all. When retracement levels fail, like his example here, that 7-month retracement, that is a typical retracement time frame. 6 to 12 months is when a retracement level to the 618, 702, 786 tends to happen. And when it fails as a retracement, look at Bitcoin. It did the same thing. It's the same thing for its retracement levels, for its bubble pops, or if you look at any other retracement levels, that retracement acts as a failure catalyst to ultimately roll over into new lows if that retracement level happens within a 6 to 12 month time frame. Okay. If a market surpasses those retracement levels at all, even under a 12-month time frame, then basically the only hope you have is a double top. Okay, that is similar to what Bitcoin did recently. There's a handful of other examples. I'm not going to get into it real quick, but anyways, you have a double top, which is always a possibility. But the biggest and most important factor in all of these things is time frame. When a market not only retraces, but surpasses all of those major retracement levels, and it does so beyond 12 months of an all-time high, then we have on every single instance, we have gone into not only new all-time highs, but a continued bull run. With the exception of one time and one time only. And no, it wasn't the 1920s, 1930s. No, it wasn't the 40s. No, it wasn't the 80s or, after the, 08 or 2000s. It was the late 60s going into the 1970s. That is the only time we have broken retracement levels beyond 12 months to ultimately then end up rolling over into new lows. It's the only time in the history of the markets. I don't know if I want to use the Dow or the S&P. Let's go back here. So, and this is the entire premise for everything we're going to be talking about today. I made a post in Discord not too long ago, by the way. I don't know why I circled this. Oh, this is the, anyways, let's get rid of this. This is irrelevant for now. All right. So here is the crazy thing about these markets. I thought that there were some pretty wild similarities. Just to make stuff easy, I'm going to do it. Even though they're not the exact same indices, they're relative. Okay. I found some very interesting things. But first off, let's talk about this retracement before I get too sidetracked. Okay. So on the Dow, you can go back. I'm not going to go through every single boom bust phase to show you that what I'm about to say is true. But trust me, I've looked at it. It's true. That anytime we get to an all-time high, we lose that all-time high and we go into like a bear of some kind, and then we go into a retracement. The only time that retracement has been more than 12 months out from the all-time high, and when I say retracement, I mean anything exceeding a 786. The only time it is ever not gone on to a new all-time high, where that retracement took place greater than 12 months out from the original all-time high, was the late 60s going into the 70s, and it is this time frame right here. Okay, so from this time frame here, we hit a new all-time high in 1966. Looks like January-ish of 1966. We then bottomed out at roughly October of 66. Okay, so you're looking at roughly 10 months. Okay, 10 months from top to bottom here. Very similar to what we did here, okay? We peaked in, call it January 2022, and we bottomed in, what do you know, October of 2022. 10 months. An identical time frame, January to October. And in that moment, we then began our retrace, our climb, okay? And we broke barely all fib levels. I don't know where the 786 is on this one, but bottom line is we got at least above the 702 into the 786, and we broke it. Only, okay, to then roll over, but set a new higher low, and then ultimately roll to a double top. Okay. This is the only time, and this, by the way, so this is October of 67. So this is a year. This is 12 months after 66. Okay. So it is what, 12 plus 10. We're looking at what, 20, right? 22 months, give or take. Very similar. So if you look at our October 22, we have now peaked in, you know, roughly what, August of 2023. Again, surpassing all retracement levels. Okay. At roughly the same time, maybe a couple months shorter. So, you know, from top to bottom, this one was, you know, closer to 22 months, give or take, 20, let's call it 20 to 22. And here currently we are more like, you know, 10 and 8, so more like 18 months, okay, to that peak. Either way, beyond 12 to 14, which is the marker. It's the only time we have gone above a retracement level and not gone on for a new bull run, okay? Because ultimately what we did is we topped, we then came down, set a new higher low, and then we double topped in, call it December of 1968, give or take, okay? So from this top to this top, again, you're January 66 to, call it December of 68. So what is that? It's roughly 3 years, give or take, I think. Is that what it is? I think it's 3 years. Ironically enough, if we were to repeat something similar here, then 3 years out from January 2022 would ironically put us around, call it December, sometime between October and December of 2024. Ironically, right around election time, which is ironic. Here we go with some crazy conspiracy theories, but how interesting would it be if the Biden administration and everyone else, all the powers that be, were doing everything in their power to kind of keep things afloat, to hopefully make everything look good, to get this man reelected in November of 2024, only to, once you actually get there, that's when everything kind of starts to roll over. I think that would be an ironic twist of fate that we can kind of hold water until then. And so ultimately my whole issue with Finance a Lot and everybody else is that they're talking about, like, look at this, it's the same thing. They're not on the same time frames. You have to look at more than just, you know, peaks and troughs and retracement levels. Time frame, time matters. And I would argue that it's probably the most important thing, or at least one of the most important things. And to ignore it is disingenuous or naive, one of the two. And I believe this is what we are in store for. I believe we are in for a repeat of this. I believe whether you see a double top come towards the end of this year, or it gets dragged out to be something very similar to that late 60s, early 70s, into the 66 to 69. I think that's what we're in for. I think we are in for a double top. Conspiracy theory, am watching like a hawk the banning of Congress from trading stocks. We had oh my God, we had the Fed ban their members from trading stocks, coincidentally, at the very top of the market, in November, December of 2021. I forget exactly what it was. They banned their members from trading. And we've heard lots of clamoring for Congress now talking about doing the same. If we get to all-time highs, or very close to it, and we also then simultaneously get a ban on Congress from trading stocks, I am telling you right now, I am running for the hills. I will be offloading almost everything I have. I will be selling all of my crypto. I will be selling all of my short-term or shorter-term trading equity stocks, and I will probably even adjust my contributions and not liquidate, like pull it out, but just put into some cash type low risk items for my 401k. I think it'll be the wildest red flag I've ever seen in my entire life. So anyways, because I believe this is my base case. It's also why I have said 100 times over the years that I think Bitcoin is its best shot. I also think, just like I think of recency bias in everyone calling for this Great Depression type thing, I also think we have a huge recency bias in crypto, in that, like, this assumption that the bull run is just going to be guaranteed to come, to me, is a huge red flag. And I think the most likely scenario is that we bounce to somewhere around that same fib retracement level. Okay. I think that, some retracement into this like 618, 712 area, call this upper 40s, 50 range, is the biggest likelihood if we do what I think, which is over the next 3 to 6 months, or even year, right? Sometime between now and end of 2024 election season. When we come to that double top range, I think the likely equivalent move for crypto would be a retracement into that to ultimately roll over. And I think there is a serious game theory to be said, or I think there is game theory to contemplate and think about when it comes to this next halving. Everyone's talking about bull run post halving, and I think there is a strong likelihood that come the halving, that the halving for the first time ever acts as a sell the event moment. I don't know. But again, as always, I'll be watching the Bitcoin dominance, and I've said all that stuff in previous videos. I'm not going to go over that again. But I think there's a strong likelihood, especially with the greater likelihood that we're actually getting closer to a recession. I don't know how the ETFs play into this. I think that is a huge potential catalyst. But ultimately, for me, the driver of everything is the broader markets. Bitcoin ain't going to do shit without the broader markets leading the way. And if my thesis of double topping and ultimately rolling over, similar to what we did in the 70s, then Bitcoin has to follow suit. And so that's why I believe that's the greatest likelihood. Everything is about percentages and likelihoods, and nothing is set in stone, but this is what I foresee. And the crazy thing is if you look at how we everyone likes to, everyone likes to use this. Here, actually, we'll do, here, let's do this. Everyone likes to, let's go to the Dow. Everyone likes to compare the 1930s crash, okay, to now, and they'll show you this. They're like, well, you know, we had this and then this, right? And they'll say that this looks exactly like the 2000s, and then the 2008, and then we had this massive run up, and then this massive bubble pop, right? That's what they'll use as, you know, similarities between, you know, fast forward to this, right? And they'll say, well, look, this is what we did in the late, you know, teens, early 20s. We had the run up, and this is ultimately going to roll over. But what I would argue is, while that does look similar, I would argue that this looks just as similar. That you had the 2000s, then you had the 2008 flush out, and then you had this massive run up. And ironically, this little guy right here still looks like an awful lot like COVID, little mini version, right? Before you hit your top. And if this were all to be similar, that, and then you look at this. I mean, look at this. This is the fucking wildest part about all of this. Hope you are still here watching, because this is the shit that is fucking crazy to me. You look at where it bounced off of, okay? Yes, this looks like COVID, but you have to look at when were the last major market moves, okay? Look at how picture perfect this bounce is. And then you look at how picture perfect this bounce is. And if you look at the Dow, it's even more spot on. But you look at this, and this is, I mean, we are literally playing this thing out almost identically, okay? And then you rally up and you hit a double top, and then you break this new low. And I think that that is likely what could happen, is that we then in drawing mode. I don't know what this is. I'm really bad at stuff. All right. And that, well, actually, let's take this back. So I think what's going to happen is we're going to come down, and then we're going to come up, and then we're going to come down, and we're going to break this level. Okay. We're going to break it. My line in the sand is probably somewhere all right, and a bunch of little squigglies. So we come here, we tap, we double top, we break the low. We then come in and set a new all-time high, break the low again, and then we kind of work our way out. And it's a lost decade. And I foresee something very similar happening here. I have for a while, I think that we are going to play between roughly 3,000 and 5,000 for a while. I think that's what we're going to do. I think we're going to play between 3,000 and 5,000 for the next decade. And I think we are, I mean, you look at the inflation scenario that we're in right now. Now, I think that the 70s are entirely different than what we are in now in terms of like the reasons for inflation and all of that. And I don't think it's going to be as entrenched, not in the same ways, because we don't have the population boom and the massive demand from the largest population boom that's ever existed here in the US, all hitting working age, right? Like that's why the 70s, it's like not only, it's like we had this massive demand shift, which drove, you know, wages through the roof because you had all these people into the workforce. Anyways, we don't have that now. Anyways, I think we're going to be battling some population decline issues and birth rate issues, but that's topic for another day. I think this is the most likely scenario. And so what I am watching is I'm watching this right here, that we have some sort of a double top, maybe get an inch higher. I wrote a conspiracy theory post a while back on how ironic it would be that if we basically did this exact same thing for the regular markets, when Bitcoin did this, set a new all-time high. And I basically said that Bitcoin was essentially leading the markets, and that how ironic it would be if we did the exact same thing in the equity markets. And I think that is the most likely scenario at this point. And so when I said that, I was like, well, if that does happen, and if Bitcoin is leading the markets, then to me, what that means is when the equity markets does do this, that Bitcoin will not also set a new all-time high, but it will roll over at your big retracement levels as we enter a period of a recession. Not a 1929 Great Depression, but a strong recession, moderate growth, and that we're going to kind of meander through. I think that is what we have in store. I think right now the greatest pain trade is to do not what everybody on crypto Twitter is saying. No blow off top, no 1930s depression, that we just do a lot of, and it won't be boring. There'll be some pain involved in this recession, but it's going to be sideways chop for a year. And we're going to retest the lows at some point on the S&P. Maybe break them down to 3,000, but we're going to plan a range between 3 and 5. And one of the biggest reasons I don't think we're going down that low is because there's too much money in the system. See, the reality is people don't forget about how much money, 40% of our money has been created this year in this last term. So if we do break 3,000 and you look at inflation, right, and you kind of factor all of that in, if we actually get to 3,000 on the S&P, like the equivalent number, I don't have that chart up, but like when you like factored in against M2, it would be the equivalent of like an 80% drop. But you're not going to get that because there's just too much money in the system. So even though the 3,000 is actually going to be on dollar for dollar terms, 3,000 is probably the equivalent of like a 2,000, right? So like if I say we get to 3,000, but if you actually do this divided by M2, it probably would be the equivalent of like a drop all the way to the bottom of COVID of about 2,000. So, but it doesn't mean we're actually going to get below there. So that is, those are my general thoughts on everything. I think the student loan thing is going to be an issue. And I didn't realize how big of an issue it was until recently. And I think there's going to be a huge liquidity trap. I think it's why Biden is trying so desperately to pay it off. Not because he gives two shits about people's student loan debt, but because I think he knows it is going to affect the economy and him getting reelected. Hence the reason why he's trying to offer to pay this stuff off, because it's going to be a major burden on society and his voting group. So I'm watching that. I think, the rates are eventually going to come to roost and create some issues. I do think that we're pretty much done raising. And as always, I think the cut is what we're looking for in terms of, what's the trigger for more downside. But that's it. That's my general thought. That's my rant on where I think we're going, what we're doing. My bet currently on a little bit of a longer term time frame, right, 6 to 12 months, is double top, maybe barely set a new all-time high in equities. And God forbid that happens at the same time as Congress decides to ban trading for their people. If it is, run for the hills. I expect that if that were to happen, all of this happens along with the timing of the halving for Bitcoin here in the beginning of 2024, maybe bleeds into slightly after, but that I think that's going to be close to the peak depending upon how Bitcoin dominance also plays into that rise. I think there's a chance that as this double tops, maybe as Congress bans, maybe as the halving comes along, and as Bitcoin gets to its 40 to 50K retracement levels, that is when the economy begins to roll over in 2024. Not into a Great Depression status, but into something where, we take out this low, maybe hit 3K, and we bounce around for a decade. Those are my thoughts. There's another post I saw from somebody that kind of really gave me some pause in terms of like where the crypto markets are right now, and whales and how they manipulate and can leverage the market because they control so much of it. And I thought it was a super wise thing. Like, if you're trading with millions or billions of dollars, a 2x is amazing, right? I think only those people who don't make a lot of money, who are trying to 1,000x and get rich for the first time, are the ones investing in all these altcoins. But the big whales, they don't need to do that. They just need to double, maybe triple their money, and they're good. And so the idea was like, what's easier to double, 30 to 60 in terms of Bitcoin, or 20 to 40? And it was like almost an aha moment. I was like, holy shit, that's exactly what's going to be on the table. Is going from 30 to 60 for Bitcoin is going to be extremely difficult in my mind. 20 to 40, it's not that difficult. So if they can drive it down to 20 to get that double at 40, that is significantly easier than trying to take it from where it is now or where it was at 30 to go from 30 to 60. So that makes the most sense to me. What makes the most sense to me is maybe we see a little bit further of a drop here, just like we saw back here. Comes down a little bit, right here, comes down a little bit more, like we're right here, comes up, drops down, everyone screams for new all-time lows. Bitcoin gets to 2021, the stock market gets to, God, it would have probably come down, up, down, let's say it comes to like 3,800-ish, so maybe somewhere around here. There's a pretty good support range right here, maybe around 4K. Right as Bitcoin hits 21, and then we go to new all-time highs or double top. When we double top in the stock market, we get to between 40 and 50K Bitcoin, and then we roll over. Happy Sunday.